The disaster in the stock market has toppled a few of what have long thought to be the pillars of good investment practice. One of those pillars has to do with portfolio strategy. Joining me today is the man regarded as the father of modern portfolio theory, Harry Markowitz, Nobel laureate and professor at the Rady School of Management at the University of California in San Diego. Harry, thanks for being here.
Thank you.
Now, in this broad market collapse, a lot of things didn't seem to work as advertised. Did you think that portfolio strategy and diversification held up as you expected?
Well, you have to distinguish between high beta stocks and low beta stocks. A beta is the extent to which you would expect a given security to go up and down with the market. So the S&P 500 has a beta of roughly 1. Emerging market has higher beta. Bonds have lower beta. And in fact, while the S&P went down 38.5%, the emerging markets went down much more. Corporate bonds went down very little. Government bonds went actually up. So those things performed as one would have expected.
A lot of people's experience of portfolio practice is a financial planner plugging their investments into a calculator and making minor adjustments in their weighting of value-oriented stocks and growth-oriented stocks. Is that form of diversification oversold?
Well, it's important to know that there is no high return with no risk. Portfolio theory, modern portfolio theory, presents the user with a risk-return trade-off curve. If you want a high return on the average, you have to put up with volatility in the short run. If you want stability in the short run, you have to take less return on the average. So one of the jobs of the important jobs of the financial advisor is to make sure that the client gets to the right point on this risk-return trade-off.
When it comes to applying modern portfolio theory to their own investments, their own 401ks, say, what mistakes do investors typically make?
The typical mistake of the small investor is to buy when the market is high and they think it's going to go higher, and then sell when the market is low and they think it's going to go lower.
Well, that's a tough impulse to fight these days. I would think anyone who's had their money in the market for the past 18 months is really fighting the impulse to pull out. What's your advice? How do you convince yourself to stay aboard?
If you're an individual and you don't have a financial advisor to compute an efficient frontier and get a sophisticated mix of asset classes, you should you should split your money between a broadly diversified portfolio of equities and then bonds or cash equivalents or something, and get a mixture that you're willing to live with.
Harry, thank you for your insights. Thanks for joining us today.
My pleasure.
I'm Eric Schoenberg for MoneyWatch.com. Thanks for watching.